It's a scene straight out of a market regulator's worst nightmare. Yields on Chinese government bonds have been plunging to dizzying lows amid an unstoppable debt rally that seems to defy all economic fundamentals. As fear and uncertainty grip the world's second-largest economy, investors have been piling into the relative safety of sovereign bonds, creating potential dangers that Chinese authorities are now scrambling to address. The numbers are staggering. 10-year bond yields have dropped to just 2.65%. A level not seen since the dark depths of the global financial crisis over a decade ago. This relentless rally has left policymakers understandably jittery about the formation of an outright bond bubble that could wreak havoc when it inevitably bursts. But curbing the excesses of the current frenzy is proving to be a Herculean task. The People's Bank of China has already brandished its formidable arsenal, declaring last week that it has hundreds of billions of yuan worth of bonds to potentially unload to put a damper on the dizzying rise. And now, we're seeing regulators take the fight to the front lines, pressing local lenders to shorten the duration of their bond portfolios. According to sources familiar with the matter, local branches of the National Financial Regulatory Administration have been scrutinizing banks' bond investments during their routine monthly checks, specifically urging them to reduce the average maturity of their holdings. It's a prudent move, meant to limit their exposure to potential interest rate risk that could translate into punishing losses if yields unexpectedly spike higher. After all, as Pan Gongsheng, the head of the Chinese central bank, bluntly stated just last month, any financial institutions holding large quantities of medium to long-dated bonds could face interest rate risks that demand vigilant monitoring. The scars of the sudden collapse of Silicon Valley Bank in the U.S., brought on by its disastrous bond portfolio bets, are still far too raw and recent. But here's the rub: attempting to arrest the dizzying bond rally may be a fool's errand in the current economic miasma. With growth sputtering, foreign investment inflows drying up, and concerns swirling about a potential banking crisis, there remains an insatiable demand for safe haven assets from Chinese investors. Yields on corporate bonds, distrusted by many, remain elevated, obliterating any allure. And with the property sector still in the midst of a wrenching slump, real estate no longer offers the siren song appeal of the go-go years. So despite the potential distortions it may be fostering, the great bond bull run promises to persist, barring a shock-and-awe campaign of truly gargantuan selling by the Chinese authorities. As one fund manager gruffly told me, unless the government starts unloading bonds in an absolute tsunami, this rally won't stop. There's just nowhere else for money to go. Which leaves Beijing facing an unenviable Hobson's choice, struggling to wean investors off the bond market's current excesses through careful goading, cajoling, and baby-step prophylactic measures, or taking a bigger gamble by attempting to detonate the bubble through an explosive shock of supply that could destabilize markets and potentially unleash the very risks it seeks to contain. It's a high-stakes, finely calibrated challenge akin to open-heart surgery. Applying too little pressure allows the artery-clogging buildup of yield-starved speculative froth to grow unchecked. But being overly aggressive could send the patient into a new crisis of soaring borrowing costs and banking system trauma. For now, Beijing seems inclined to take the more cautious, graduated path, leaning on lenders to pare back their interest rate exposures through not-so-subtle reminders from regulators to reduce portfolio duration. It's a sensible tactic that provides policymakers with valuable optionality if the bond frenzy spirals further out of control. But as is so often the case in the ever-evolving world of markets and human behavior, more dramatic interventions may ultimately be required. As a senior regulatory official ruefully told me, a prudent man avoids danger and turmoil, but occasionally, in times of upheaval, he has no choice but to face it head-on. And in today's uncharted waters, upheaval may sadly be the new normal.